Innovative Industrial Properties ticker IIPR is currently trading at $80.40 and is down by about 20% since the last 6 months. If we have a look here, we can see that the company has entered the stock market in 2016 and since then rose to a value of $279, but then it fell back down to about $80. Now this company is currently trading at a fairly low value compared to what it has been trading in the past. I want to see if it might be trading below its intrinsic value and if it might be a buy now or in the near future. To do this, we'll jump over to my stock analysis tool where we'll have a look at the 9-player analysis and find the intrinsic value of IIPR using the Grams formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. Now, if we jump back to statistics, we can see that the current dividend yield of IIPR is at 8.77% and the cash flow per share is at $1.80 per quarter. If we have a look here on the left, we can see that the income has been increasing by about 35% since 2022 to 2023. We can see down here that the free cash flow has been increasing by about 35% as well. Down here we can see that the analysts currently project the price of $138.80 for the next year, which compared to the current price of $81 is about $50 higher. The current market cap of IIPR is at $2.3 billion. Now here we have to make a very important observation, and that is that IIPR has been growing at a perpetual growth rate over the last few years due to it being a fairly new company to the stock market. This might be one of the reasons why income and free cash flow have been increasing at this high rate. Now, this does not tell us anything bad about the company, it just lets me know as an investor that I have to proceed IIPR with a little bit more caution. Now, let's move to our 9-player analysis. Here we can see that the 5-year P ratio has not been below 22.5, and a high P ratio is actually quite common for new firms. I did make a note here on the side that the average P ratio for the year 2022 has been at 25.7, which means that the P ratio of IIPR is decreasing, which is of course a good thing. Next, we want there to be a 5-year profit margin over 10%, which there is, and we also want there to be revenue and net income growth over the last 5 years. As we can see, these two have been increasing at a really high rate, which again is because the firm is growing at a perpetual growth rate. Now we do have to account for the fact that such a high increase year over year is simply not possible, and that in the next few years this increase will lower. The next pillar says that we want there to be a decrease in shares outstanding, but as IIPR is a new company, an increase in shares outstanding is actually a good thing as the firm is currently in its growth stage and it uses the money from investors to develop. Next, we want the long-term liabilities over the 5-year free cash flow to be lower than 5, which it is, and we want there to be an increase in free cash flow over the last 5 years, which there has been, and also at a really high rate similar to revenue and net income. We want the price to free cash flow over the last 5 years to be lower than 20, which it is, and finally we want there to be consecutive dividend growth, which again is at a really high rate. Now let's move to calculating the intrinsic value. First we're going to apply the Grams formula revised. I plugged in the earnings per share, and using the base P, 5-year earnings growth estimate, growth rate multiplier, and the average yield on AA core bonds, I calculated an intrinsic value of $21.82, which is 73% lower than the current trading price. Now we have to take into account that the Grams formula is based on the earnings per share of a company, and it does not mean that when a company has low earnings per share that it is necessarily a bad company. Therefore on this channel we use 4 different valuation methods to calculate the ultimate intrinsic price of a company. But now let's move to the discounted cash flow model analysis. Here I plugged in the free cash flow over the last few years and calculated an average growth rate of 140%. I then took the analyst growth rate projections for the next 5 years and calculated my own growth rate of 4.66%. Now you might think that this is quite lower than the average growth rate we have calculated, but as you can see, even though the free cash flow has been increasing, it has been increasing at a decreasing rate, and that is because the company is new, and as I stated before, it is growing at a perpetual growth rate. Now I use this calculated growth rate to calculate the future free cash flow values, and then I calculated the present values of that future free cash flow using the discount rate. I then summed up all the future free cash flow, added any cash and cash equivalents, subtracted total debt, and got an equity value of $4 billion. I then divided that by the shares outstanding and got an intrinsic value of $148. Let's now move to the next valuation, which is the multiples valuation. Here I compare IIPR to MPW, Peak, and HR. I took these companies' stock prices, divided by their earnings per share, and got their PE values, which I then averaged out and multiplied by the earnings per share of IIPR to get an intrinsic value of $76.90, which is about $5 lower than the current trading price. Let's move to the dividend discount model. Now, as we can see, the growth rate of IIPR has been over 50%. Now, when the growth rate is over the WACC of the company, the dividend discount model does not work as it gives you a negative value. Therefore, I use an alternative model which is based on the next year's stock price predictions. I use this alternative model to get a DDM price of $138. Now we can move to our final valuation where we average out all the valuations, the grams valuation, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an intrinsic value of $96.11. Now, as the alternative dividend discount model is based on the analyst's projection prices for the next year, which are quite different to the current price of the stock, I don't really want this model to be in my final valuation. Therefore, I'm going to remove it from the valuation to get an intrinsic value of $82.21. Now, based on our 9-pillar analysis, I would want to apply a margin of safety of say about 12%. Which would give us an acceptable buy price of $72.34. Before we finish this valuation, we're going to jump to my interactive brokers account where we can see that the analysts project an earnings per share for IIPR to be at about 7 by the end of 2024. We can also see that they predict a slowing down dividend growth rate by the end of 2025. And finally, further down, we can see that they also predict revenue growth for IIPR. If you enjoyed this video, make sure to leave me a like and let me know down in the comments which company you would like me to evaluate next. I upload 2 to 3 times a week, but if you are thirsty for more evaluations, you can see them on the screen right now.